Joining me now is HSBC Global Research's Max Kettner. Max, it's great to have you on, and I want you to take us sort of back to how you were thinking about things starting the year and where it's brought to you right now, because I know you were bullish in 2023, correctly so, and you thought maybe we'd get some payback. It didn't happen.
Yeah, thanks for having me. Look, that is exactly right. We started the new year basically thinking that, shorter-term inflation expectations already subsided quite a lot, right? When we looked at, for example, two-year break-even inflation in the US, right, what tips were pricing or what even inflation swaps were pricing at the front end. In all of them, we were actually starting to look at sort of below 2% inflation expectations for the near term. So having played all that Goldilocks and disinflation theme last year, and like you said, right, we've been pretty bullish last year, we sort of thought, look, we don't even need to have a view that there's a big next inflation wave coming. All we really need is one or two data points on the inflation side that might be surprising a bit to the upside. Then we get inflation expectations up. We've got rate expectations perhaps repricing a bit higher. And that then will weigh on multiples, will weigh on equities, but it will also weigh on credit spreads, right? So for us, that's what we thought is this sort of reverse Goldilocks period where for at least a couple of weeks, we're going to hit the pause button on all the asset classes. But clearly it hasn't happened, right?
Yeah, in fact, what we have seemingly is sort of Goldilocks on steroids here, because you both have the soft landing somewhat coming to pass and getting priced in by the market, as well as you have this extra kicker of the excitement around AI-related technology. So I guess where does it lead you now in terms of positioning? Do you say, well, we missed the move, but we're still cautious, or is it time to play?
No, I think, look, we missed the move, right? We definitely missed the move, particularly in equities and in high-yield credit. I think emerging market debt is still something where we're a bit cautious around, right? Both on the emerging market, local currency and hard currency debt side, but that's a subset, right? Otherwise, we've closed the underweight in equities. We're neutral there, but we've actually almost gone full on maximum overweight in high yield credit once again, just like last year. Because, when you look, for example, at high yield, the next refinancing wave only really comes in the second quarter of next year. So it doesn't really pay to be sort of on the sidelines and say, maybe spreads go up 10 basis points and then I'll buy it. That, you just can't play that move, and you can't really time that move as well. On equities, perhaps we start to see a bit of a dip in the next couple of weeks. Perhaps, for example, the February inflation data is a bit higher than expected. But what we thought at the start of the year would be a sort of 10% plus X setback, that looks increasingly unlikely simply because rates have repriced, right? Rate expectations are no longer as exuberant. So, with rate expectations already being much more realistic, it's also unrealistic to us to say, oh, yeah, this is the factor that's going to send everything down. We've got to be more realistic and say, yeah, a dip of a couple of percent, but you've got to jump in really quickly then.
And I guess you mentioned that the whole rate path that central banks might take has been repriced to a fair degree. How much do we actually need outright easing by the Fed, or do you think that this is just kind of a steady as she goes economy right now and the rate structure is okay?
Yeah, to be honest, the economy is pretty fine in the US, right? Even in Europe, I would argue, it doesn't really need an awful lot of upside surprises to be massively surprising to the upside. Not because the European economy is so great, right? But, I've probably not been the first guy on the show to say, Eurozone economy doesn't look great. Germany looks like it's the sick man of Europe again. Everyone kind of knows that, right? Yeah. And with such a bearish setup, even in Europe, if you got the tiniest little bit of like a whiff of upside surprises, that's a massive, massive upside surprise. So to me, it's steady as she goes, both in the US, particularly relative to very, very bearish expectations, even in Europe. And that, for me, tells me we don't need as much easing as the market has expected at the start of the year, perhaps sort of 2 to 3 rate cuts. I guess the market could take it as a bit of a disappointment if indeed the Fed dot plot does get changed to 2 rate cuts only. But, that's a risk, and it's only really a temporary setback. I think as long as we are seeing a few rate cuts this year and sort of the path of least resistance for rates is to go down, that's good for spread products, it's good for equities.